14 of 21 series are aligned with stagflation mild this morning. That is a moderately coherent reading of decelerating growth and accelerating inflation across the framework. The current macro regime is stagflation mild, with a confirmation score of 14 out of 21. The macro regime reads as growth decelerating at minus 0.11 and inflation accelerating at plus 0.01. That is the mathematical signature the framework assigns when activity softens while price pressure retains upward momentum. The coherence score sits at 14 out of 21, and the confirmation score also sits at 14 out of 21, which the engine classifies as moderate alignment. Compared with last week, the framework's growth reading has softened, while the Atlanta Fed's GDP tracker has improved over the past 2 sessions inside the regime line. By our framework's reckoning of comparable historical conditions, a confirmation score in this range held in roughly 41% of cases over 3-month windows, with the most frequently observed next state being acceleration, a characterization of past patterns under our methodology, not a prediction of what comes next. Environments like this have historically felt uneven across markets. Broad indexes often moved sideways, defensives and real assets held firmer, and cash preserved purchasing power better than in cleaner expansion settings. The 10-year Treasury yield is at 4.70%, which the framework places in an unfavorable momentum state for inflation pressure because higher long yields often tighten financial conditions and press on valuations. In our framework's reading of comparable periods, this roughly coincided with inflation composites showing acceleration in 9 of 11 similar instances within the historical sample, an observation under our methodology, not a forecast. The question for a reader is whether higher long rates still fit current pricing, or whether the market is already discounting a slower economy. Non-farm payrolls remain one of the clearest labor signals in the framework, and the red designation here reflects weakening momentum in employment growth relative to its recent trend. In our framework's reading of comparable historical conditions, roughly 7 of 9 similar labor slowdowns coincided with a deterioration in the confirmation score within the subsequent stretch of sessions, a record of past behavior, not a forecast. What matters is whether hiring stabilizes or keeps softening, because labor often tells markets how much demand pressure remains in the system. Credit conditions remain watchful, with high-yield spreads functioning as the market's stress gauge for lower-rated borrowers. The red reading in this layer reflects a less forgiving risk backdrop, where financing conditions are not as easy as they were earlier in the cycle. In our framework's reading of comparable periods, roughly 7 of 9 instances with this kind of credit pressure coincided with a weaker confirmation profile within the following weeks, an observation under our methodology, not a forecast. The practical question is whether financing stress stays contained or begins to bleed into broader risk assets. Among the cross-asset signals, long bonds are stronger and energy is softer, which fits the day's mix of falling yields and weaker oil. Long bonds are a useful barometer for growth anxiety, while oil speaks to inflation impulse and demand tone. In our framework's reading of comparable conditions, roughly 6 of 10 similar combinations of firmer bonds and softer energy coincided with a calmer volatility profile within the next month, a record of past behavior, not a forecast. What would challenge this read is a renewed rise in crude or a reversal higher in yields. If the 10-year yield crosses 4.45% and holds for 5 consecutive sessions, in our framework's reading, inflation acceleration appeared in 9 of 11 comparable conditions. A historical characterization, not a forecast. That threshold matters because it would add another layer of pressure to the inflation side of the regime. If fear and greed drops below 15 and holds for 5 consecutive sessions. In our framework's reading, the confirmation score deteriorated in 7 of 9 comparable conditions, a historical characterization, not a forecast. That would matter because it would mark a clear shift from today's greed reading toward a more cautious market structure. The map is live. These conditions are being monitored daily across all 21 series.